Welcome back, everybody. There's one stock that's driven the sentiment in the market for the past year more than any other. And that stock,
Nvidia.
But I've pretty much ignored Nvidia because their run-up was so crazy and I just didn't understand the nuances of their business. I talked about them briefly last year when they jumped from $300 to $400, but I didn't really dig in and I kind of assumed that they were this crazy overvalued bubble stock. And of course, they've more than doubled since, and their valuation metrics actually look better than they did last year. So I decided I'm going to stop being a hater. My portfolio has suffered enough from my pride, and I'm going to finally understand this business a little bit better. So let's take a look at Nvidia, and we'll dig into some basic stats first. Now, Nvidia at the time of this video is trading at $860.94 a share, and over the past year, they've returned a staggering 232%, which is over 7 times the S&P 500's return. And if we look at year to date, Nvidia is already up over 70%. Now, if we look at some basic valuation metrics, obviously, it's not going to be very pretty. Nvidia is trading at a 74 price to earnings ratio and a 77 price to operational cash flow ratio. But if you look at their projected ratios, taking into account projected growth, they're trading at a 38 price to projected earnings and a 38 price to projected cash flow. And this really gets to the heart of the matter with Nvidia. It's all about ridiculous growth. And just looking at the growth tab, it's all A+ dark green with just eye-popping numbers, both with the year-over-year growth as well as projected. And when you mix that with their profit margins, which you can see, not only are their margins great, but they're improving. And we'll talk about why here in a minute. So Nvidia is obviously an extremely high growth company with margins that are really good and still improving. And while their current valuation is definitely high, their projected valuation looks, dare I say, reasonable for the amount of growth that they've had over the past couple years. So what is their business actually about? Well, let's dig in and find out. How does Nvidia make money? Now, NVIDIA's revenues are broken down into 2 major segments, compute and networking, which consists of data center computing platforms and end-to-end networking platforms, including automated driving platforms, robotics, AI enterprise, and cloud services. And then the other segment is graphics, which consists of GPUs for gaming and PCs, as well as gaming streaming services, infrastructure, and solutions. And if we take a look at how the revenue and profits align to each segment, for compute and networking, it accounted for $47.4 billion in revenue over the past year, which represented 78% of their total revenues, which was actually up from being only 58% of the revenues the year before. So extreme growth in this segment, which makes sense because that's where the AI stuff is. It contributed $32 billion in operating profit, which is a 67% profit margin. Now, the graphics segment accounted for $13.5 billion in revenue over the past year, which represented 22% of their total revenues, and it contributed $5.8 billion in operating profit, which is a 43% profit margin. So in a nutshell, their highest growth segment is also the one that has significantly better profit margins, and so that's why their profitability has been improving overall. Now, we're going to talk a little bit more about the AI-related products in their compute segment here in a minute, but first, let's take a look at some basic financials. NVIDIA's revenue has just been ridiculous in terms of growth, while costs have risen, but at a slower rate. And if we look at cash flow, it's the same story. Unbelievable growth, while things like CapEx have stayed relatively the same. So it's a business story where NVIDIA has continued to innovate and finds itself as the market leader in the hottest industry in the market right now. And they're leveraging that combination of being the market leader and having extremely high demand into higher prices, into subscription services, and all those things together mean astronomical revenue growth with minimal growth in costs, which on a basic level is ideal for how a business can grow. I mean, if you have a situation where revenue's doing 5x and costs are doing 2x and profit is up 10x, then that's attractive math for any investor, which is partially why the stock chart looks like it's going up only. And just to take a quick look at their debt situation, they have basically zero net debt with $11 billion in total debt outstanding, but over $25 billion in cash and short-term investments. So incredibly healthy balance sheet. And if we just take a look at the cash flow statement real quick, you can see that they've been aggressively buying back shares with their cash flow at a rate that's way higher than any increase in shares issued or stock-based compensation. So the primary question for investors as it relates to Nvidia is simply, do you believe the growth story is going to continue to meet or exceed expectations? Because everything else looks really good. So to dive into that a little bit more, let's talk about some risks. So for risk number one, losing their market-leading position. And now, this is obviously a big one because their rapid growth, their improving margins, and their pricing power are all predicated on NVIDIA having the best chips for the companies that are trying to win the AI race to want to buy. Because NVIDIA's customers have been companies like Microsoft, Google, Amazon, and Meta, who are some of the richest companies in the world with money to spend and trying to keep and gain market share in highly competitive industries. But this is where I think a little bit of education is helpful because we hear these terms in the news about AI and NVIDIA, and I don't know about you, but for me, I didn't know what a lot of them meant. So we're going to break them down right here. And it's things like, what kind of chips are there and what are they actually used for? How are the semiconductor companies actually different from each other or similar? And while Google, Amazon, and Microsoft are some of the biggest buyers of NVIDIA chips, aren't they also making their own chips? So what is that about? And just to be clear, if you're an actual expert in this space, I'm sure I'm going to say some things that may be a little off or not technically precise, but hopefully they're at least in the ballpark to help us understand kind of what these things mean a little bit more. I'm just going to caveat that right now. Now, in terms of what kind of chips are there and what they're used for, mostly people talk about CPUs and GPUs. Now, CPUs are central processing units, and they're found in your phones, your desktop, your laptops, and they're like the brain of the computer. It executes commands, and it's known for executing general tasks very quickly. But GPUs are graphics processing units and are known for being able to handle larger, more specific tasks more efficiently by dividing it up and processing in parallel. So things like crazy graphics on a computer game, or now more recently, functions related to AI. And the two functions related to AI that you hear about are training and inference. Now, training is the process of teaching an algorithm how to make the correct decision using large amounts of raw data as well as human oversight. The output of that training is a model or model data. Now, inference is when you use that model that you created in training to take an input and create the correct output. So like if we're talking about Google Gemini, which I know has been in the news for a bunch of bad reasons, but I've actually been using it quite a bit for doing research and stuff, and it's pretty darn good. But the training that Google did to create the model happened before releasing it to the public, and that training effort requires GPUs, and the better the GPUs, the larger the dataset can be and the faster it can process. But then when you actually use the Gemini UI and ask it a question and get a response back, that's inference, where it's using the Gemini model to give you, hopefully, a correct output. Or another example is when Tesla's full self-driving analyzes something like a stop sign and decides it's time to stop. Because it's using the input of the stop sign and everything else going on in the scene, and then inferring through the model that the correct action is to stop the vehicle. And the reason why it's important to know the difference between training and inference is that the type of chips that work best or that are needed for each task is slightly different. For training, you need powerful chips designed to handle complex model development like GPUs. For inference, it's more about speed and operational efficiency, which, if you can remember, sound kind of more like CPUs. And hopefully you're not too confused yet, because the reason why understanding this is important is it helps us get a better idea of NVIDIA's long-term prospects and their competition. Because up to this point, training has been a primary focus, especially by those big tech firms working on creating their large language models, or LLMs. So they've all been competing to buy whatever chips NVIDIA had, because NVIDIA GPUs are the best chips for training, like the $40,000 H100. But slowly there's more and more demand for inference applications related to AI, which don't need the same level of GPU power. Now, NVIDIA has inference chips and solutions as well, which they recently said over 40% of their compute business was actually not training related, which was pretty big news. And of course, they have their CUDA programming framework, which is widely adopted in the AI community and gives them some protection in their overall moat. But the reality is that the competition for inference chips is a little more crowded than it is for GPUs needed for training. And now, if we break down some of the competition to see how they stack up against NVIDIA, you can see that the main names that we're going to talk about are Taiwan Semiconductor, Broadcom, Intel, and AMD. And one important note to understand is the difference in companies that design chips, manufacture chips, or do both. And you may have heard these specific terms before, like fabs, or fabless, or foundries, or IDMs. Now, before you stop watching the video, I promise it's going to make more sense here in a minute. So you have fabs, which is short for fabrication, and those are facilities in which semiconductor products are manufactured. So a fabless company is one that designs chips, but then partners with another company to manufacture the chips. They're called fabless because they don't have a fab to actually manufacture their chips, they just design them. And so foundries are companies that manufacture semiconductor products as a service as opposed to designing them. So a fabless company will design the chips and then partner with a foundry to manufacture the chips. Hopefully that makes sense. And then lastly, IDMs are integrated device manufacturers who design and manufacture their own chips in their own fabs. So as you can imagine, depending on the business model that the company is using, there's going to be different expectations for profit margin or competition or even risk. And if we look at the primary list of competitors for Nvidia, it really runs the gamut. Now, Nvidia is a fabless company. They focus on designing chips, and they partner actually with Taiwan Semiconductor to manufacture the chips. Now, Taiwan Semiconductor is mainly a chip manufacturer who builds the chips that are designed by other companies, so that would make them a foundry. And for all intents and purposes, they're the leading foundry in the world, with many, if not most, of the big players using them, like Apple, Tesla, AMD, and Broadcom. And speaking of Broadcom, they're a fabless company like Nvidia and known for a broader variety of chips, including ones for networking, data storage, and of course, smartphones. Now, Intel is an IDM, where they both design and manufacture chips and obviously best known for their CPUs. And then lastly, AMD is a fabless company like Nvidia, but in addition to CPUs and GPUs for gaming consoles, they also have products for personal computers and data centers. So as you can see, in terms of direct competitor, probably AMD is the best aligned in terms of business model and niche. But that's why the shift to more inference AI solutions is going to be an interesting one, because a lot of these companies are more well known for their CPUs than their GPUs. And so they'll be looking to be a, quote, more affordable option with acceptable performance to try to take a piece of Nvidia's market share. And not to make this more complicated than it already is, but some of Nvidia's best customers have already begun to create their own chips as well. You have Google, who has their TPUs, which are tensor processing units, that they've used for both training and inference, and were created with the help of Broadcom in the design and Taiwan Semiconductor for the manufacturing. You have Amazon, who has its chips Trainium and Inferentia, and I'll let you guess which one is used for what. And then you have Microsoft, who designs their own chips as well and has used Taiwan Semiconductor like everyone else, as well as recently announcing a partnership with Intel to create chips. And then Meta's making their own chips, and of course Apple makes their own chips, and you get it. And all this is really about two main things. One, reducing the cost and dependence on Nvidia, and then two, trying to get an edge as it relates to processing speed and solutions that are available by designing great chips. So the big concern and challenge for Nvidia is their customer base of the biggest and richest tech companies in the world has been a great thing for their business. But now it's also a unique challenge as all those companies are trying to reduce their dependence on Nvidia and gain an edge. And then combine that with the fact that companies like AMD and Intel are trying to compete more directly with their business, and you can see the competitive landscape is pretty tough. And remember, the big question for anyone wanting to invest in Nvidia is, do you believe the growth story can continue to meet and exceed expectations? So understanding kind of that competitive landscape is going to be critical to figuring out your point of view. Now, if we move on to the second risk, and these are going to be a lot quicker, I promise. Economic or regulatory changes that could reduce demand. Now, outside of just general competition, Nvidia's top customers have their own issues related to antitrust and regulatory hurdles, which we've talked about on this channel before, specifically with Apple, Amazon, and Google. So any antitrust ruling that will force them to alter their strategy or maybe even reduce the cash flow they have available to spend on Nvidia chips and hardware could significantly reduce Nvidia's demand. Now, of course, these are some of the strongest companies in the world, but expectations for Nvidia are so high that even a slight pullback in demand could mean a significant pullback in the stock price. And then for the third risk, supply chain dependencies. Now, this is specifically about Taiwan Semiconductor, and I realize that Nvidia isn't the only company to be dealing with this, as many of the top chip designers are using TSMC. But it is a risk in that Anything that happens with Taiwan Semiconductor, either operationally, economically, or even politically, could significantly impact NVIDIA's business and their ability to meet their strategic goals. So, of course, when expectations are high, any obstacle that could delay you is a risk. And in this case, because there's an added political aspect to it, it makes it that much more important to consider. But overall, while there are some real risks to NVIDIA's business, specifically around sustained growth, I do think they have a significant moat still, at least for the time being. And that's because their customers are companies that are going to be extremely competitive in wanting to win in AI. And the reality, whether we like it or not, is that NVIDIA currently has the best product. So I think there's still opportunity for them to meet or exceed their growth expectations for a while. Okay, let's talk about valuation. Now, if we just look at the traditional valuation methods here, of course, it's going to look terrible. I mean, the DCF model is at $205, and that's assuming a 20% growth rate because I just can't bring myself to use anything higher than that. The price to free cash flow multiples valuation is at $537. The price to earnings multiples valuation is at $898, so definitely kind of interesting there. But there's real differences between these companies, so I'm not really sure how valuable this is. And what I've been doing more lately is less about specific traditional methods to give me a specific number and more trying to get a value range by using historical price metrics. And if we look at NVIDIA's historical price to earnings and price to operational cash flow, we can see that while they're both high in the 70s, on a relative level, it doesn't look that crazy based on their own history. And if you take into account their projected growth rates, then you'd be looking at something around here, which would look really attractive, again, based on their own history. Now, this is obviously way more art than science, and even though a projected PE of 38 looks better than a 70, that doesn't mean that it looks good. And especially when you take into account that Nvidia is already a $2 trillion company, so how much longer can it grow like that? And at the end of the day, like I mentioned multiple times, that ultimately becomes the question we have to ask ourselves as investors if we're interested in this company. Okay, so let's rate Nvidia using the 3 criteria I use to evaluate stocks: business, operational performance, and valuation. Now, from a business perspective, Nvidia is the market leader in the hottest industry. They continue to innovate as it relates to GPUs and AI infrastructure, and I didn't even talk about their conference that they just had and all the new things that they announced there, but they're continuing to push the envelope. Their software frameworks and subscriptions have helped deepen and protect their moat, and their customers have a lot of money to spend. So obviously from a business perspective, I would rate them as good. In terms of operational performance, their margins and overall profitability continue to expand. They're aggressively buying back shares with additional cash flow. They have zero net debt, but they are dependent on Taiwan Semiconductor to manufacture their chips. Still, from an operational performance perspective, I would rate them as good. Now, lastly, in terms of valuation, all their traditional models are obviously terrible. The DCF model, price to earnings, price to cash flow, those are all bad. But from a historical price metric standpoint, it doesn't look as crazy, and their projected valuation metrics look much better with their expected growth. But still, from a valuation perspective, I just don't think there's anything I can rate them other than poor. Overall, Nvidia is a company that I just really needed to dig into. It's been such a catalyst for the broader market right now, and I felt that not understanding it was a mistake. Now, in terms of if I'm going to be adding Nvidia to my portfolio, I'm not sure yet. Now, that's not totally true. Now, as of Monday when I was recording this video, I wasn't sure if I was going to add Nvidia to my portfolio, but over the last couple of days, I've been editing my video, I've been continuing my research, and I decided to add it today. And I added 20 shares at $897.85 a share. And I know people are going to be like, oh my goodness, you're an idiot. You bought Nvidia at $900. I honestly don't see it that way. Like, looking at this company, yes, are they overpriced? Of course, right? They've been run up so much in the market. And anytime you see a company that's gone up, however many X over the past year or year and a half, it always makes us skittish in terms of, well, why would I want to buy now? On some other basic level, I think they're likely to do a stock split probably soon as well, just because they're getting close to that kind of $900 or $1,000 mark, which, human nature, human psychology, how it works. Anytime these companies have a stock split, the stock tends to go up. But regardless of that, that's not why I bought it. It's just, the more that I looked at it, the more that I dug in, the more that I saw kind of how they have the best product in this industry, how I saw that, yes, there are competitors, and yes, the big tech companies are trying to build their own chips. At the end of the day, anybody who wants to win in AI or at least have a fighting chance is going to be partnered with Nvidia. And that's just how I view it. So just want to let you know that I actually did add Nvidia to my portfolio after all, and I'm excited about it. And this might be one where I do a follow-up here, maybe in the near future, just because there's so much information and things to talk about in this space. I mean, even in this video, I probably cut another 10 to 15 minutes of stuff just because it was just getting too long. But that's the latest, so we'll get back to the original video and let me know what you guys think in the comments. So what do you guys think about Nvidia? Have you dug into this company already? Are you already holding it? Let me know down in the comments below. Now, if you want to watch me go through a similar stock analysis for Amazon before I added it to my portfolio, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.